In Shakespeare's play Hamlet, a father advises his son, "Neither a borrower nor a lender be." That would seem strange to modern Americans, maybe even perverse. Looking at this picture, you might even think that continuing to acquire even more debt has become a national goal, even perhaps some kind of patriotic duty. As of the 31st of March 2024, that total is $7.7 trillion. If you set that figure out in actual numbers, you can see more easily just how eye-wateringly big it is. For context, that's quite a bit more than the $16.1 trillion of combined national wealth for Germany, Japan, India, Great Britain, and France. After the USA and China, those are the world's 5 biggest economies. What's much more worrying than the debt total is its composition. Over 1.1 trillion is represented by credit cards, and recently, that type of borrowing is where the growth has been fastest of all by far. It's an average of nearly $7,000 of debt per cardholder, and bear in mind that the interest rate on that debt is about 22% a year or more. That's worrying because credit card debt is not secured against any kind of asset. For example, let's say you borrow to buy an automobile, and at some time in the future, you find you can't afford the payments. The worst that can happen is your car gets repossessed because your loan was secured against the value of that asset. On the other hand, if you max out your credit cards, or cards, many people have more than one, and cannot pay off the debt, you will enter a world of harassment. First, there will be a series of ever more threatening letters from the issuers of the card, or cards. If you still don't pay, your account will likely be declared in default and the issuer could take you to court. The court will very likely decide that the debt can be recovered through regular deductions from your salary. If that's not enough to pay off the debt over a reasonable period, or if you've become unemployed, the court could also place a lien on your home. Whatever the debt recovery method, your credit ranking will tank. That will make it much more difficult or more expensive, or both, to access credit in the future. Moreover, a poor credit rating could make it much harder for you to get the new and better paid job that could solve your debt problem. So, there's no doubt about it. Too much debt can, in fact, almost certainly will destroy your wealth. But all of that is at the individual level. Does the same conclusion apply to the entire cohort which owes the $1.1 trillion on their credit cards? Are they, as a group, a threat to the combined wealth of Americans in general? Let's start by taking a look at how America got to this position. It will be a surprise for many to discover just how recently that story begins. Up to only 100 years ago, if you wanted to borrow money, you asked your friends, or maybe tried the local stores and tradespeople with whom you'd been a customer for a while. Your bank would only lend against the security of an asset, typically your home. Tradespeople would be doing you a favor because no interest would be charged. It was a losing proposition for them, so they lent very rarely. If none of those people could help, you could try the loan sharks. They not only set extortionate terms, but they also operated outside the law and had close links to organized crime. Non-payment of their loans could put you in danger of serious physical harm, therefore. That all changed with the rising popularity of the cheap automobiles developed by Henry Ford and soon after by other car makers at the end of the First World War in 1918. A new Ford Model T cost about $500 then. That seems cheap, but it was nearly 20 times what the average American worker earned in a week. Many, if not most, of those workers had been soldiers in the war. They received a $60 cash bonus when they were demobilized. That money felt like it was burning a hole in their pockets as they eyed those shiny new Fords at their local dealership. Spying a new business opportunity, auto finance companies emerged. They borrowed from the banks, then on-lent the money to car dealers. The dealers could then offer credit plans to their eager new customers. Everybody was made happy. The buyer got their new auto, the finance company made a profit, and so did the dealer. And of course, the economy got a boost from all of that new consumption. As the saying goes, what's good for business is good for America. as the Roaring '20s, 1920s that is, ushered in a massive post-war buying boom. The consumer credit business grew with it. Pretty soon, almost every kind of durable goods could be bought on credit. Vacuum cleaners, radios, furniture, you name it. A second credit-fueled boom happened after the end of the Second World War in 1945. As happened after World War I, 1945 also marked the start of a baby boom. This time, however, it was a much bigger new generation because the American population had grown by nearly 40% since 1918. Indeed, the boomers, as they became known, were the biggest generation ever in American history for the next 50 years or more. They loved to buy stuff. One car wasn't enough, nor even one TV set. There had to be one each for mom and pop, and in due course, one each for their 2 kids also. The result was the biggest economic boom ever in the USA and across the world. So, 8 years later, American consumers had reached their near $8 trillion of debt. That compares with the total in 2023 value of the US economy of $27.4 trillion. So you can easily see how crucial all of that borrowing was for our current level of national wealth. But could that huge debt turn on Americans and eat up all of their wealth? The first thing is to see if huge is the correct adjective. There's no denying that total US household debt is a big number, but what really matters is how it compares with household wealth. That too has been rising strongly, helping mainly by a booming stock market. By the end of 2023, the net figure, that is, after deducting the debt, is a staggering $156.2 trillion. As we did with the total debt, let's put that in actual numbers. Next, let's repeat the total debt for easy comparison. Now, add the two together. That gives us the total gross wealth of Mr. and Mrs. America. But these numbers are so big, it's almost impossible to visualize them in any kind of personal context. So, imagine your total household wealth is $100,000 before deducting what you owe on credit cards, auto loans, and the rest. If your household debts were in the same proportion to your gross wealth as the total for all US households, they would be just $10,178. It's hard to imagine that would worry you very much. However, there is one other thing to take into account. Debt is not just about the total that's owed. The cost of servicing it, i.e., your regular outings on interest and repayment, can be much more important. If all of that debt is on credit cards, your annual servicing cost at 22% of what's owed will be at least $2,239. Again, not a big number. With the average US salary at more than $63,000 a year, it looks easily affordable. However, there's a big problem with averages. Among statisticians, there's an old joke that with your feet in the oven and your hands in the freezer, on average you should be perfectly comfortable. Obviously that's nonsense, and especially so that America has a big problem with inequality of both wealth and income. In fact, not just a big problem, but one of the world's biggest. Financial inequality is measured by the Gini coefficient. A figure of 0 means no inequality at all, while a score of 1 signifies complete inequality. By this measure, the USA has the 5th widest gap between rich and poor among the 38 member countries of the OECD, the Organization of Economic Cooperation and Development, a group of most of the world's richest nations. It is of course extraordinary that the world's richest nation, the champion of democracy, the land of the free and the home of the brave, should generate such egregious inequality. It's not just that poorer Americans have high levels of debt in relation to their income or wealth, it's also that the reasons they borrow are very different from more prosperous people. Most better-off Americans take out loans in order to buy cars, houses, and other durable goods. Not only is the debt secured, therefore, but the spending it finances helps the economy to grow, and is therefore a benefit to the entire nation. Not so among the poor. The great majority of them pile on credit card debt in order just to live, paying the rent, Very few are homeowners, buying clothes for their kids, or even buying food. Quite literally, it's a hand-to-mouth existence. And also, being American, there is a strong racial element in this rich versus poor divide. About a quarter of all African American households have either no wealth at all or are in debt-negative wealth, as economists say. This inequality, along with social tensions, is the main economic threat in modern America. As we have seen, there really isn't much of a problem with the overall level of household debt. There are more than sufficient assets to secure it, and there is way more than enough income to service it. Besides, as our first chart showed, the overwhelming majority of the debt is related to housing, i.e. mortgages, home improvement loans, and the like. Here's the chart again. What it all boils down to is that American household debt is just an economic or financial issue. It could be a fundamental social problem. That's because the debt is so unevenly distributed, with those least able to afford it having the highest indebtedness relative to their income, that is. Throughout history, such financial and social division have fueled rebellions and revolutions. In some cases, those upheavals upending the existing social order completely. The French Revolution comes to mind as one example, admittedly an extreme one. It ended the French monarchy, for a period at least. The English Civil War, 1642 to 51, was another. It led to the public beheading of the King Charles I. Okay, we mustn't get carried away. The likelihood of a second American Civil War is pretty remote, to say the least. Even so, how can it be economically or socially healthy to have half of the nation living from paycheck to paycheck, more than a third having more credit card debt than savings, and almost a quarter having no savings at all? Surely, such an enormous gap between those who have and those who have not isn't sustainable. And if it isn't sustainable, what will bring it to its inevitable end? It's unlikely to be the destruction of household wealth. However, already high consumer debt leaves little room for faster spending growth. Without that increase, consumption, which is one of the economy's main drivers, is likely to be under pressure. So, will Americans' love affair with debt destroy their wealth? No, but it is likely to undermine the growth and wealth of America itself.